Okay.
Now we will talk about dividends, and we'll talk about cash dividends, property dividends, and liquidating dividends. The book talks a lot about the dividend policy. We generally regard, if you have retained earnings, they're available for dividends to stockholders unless they've been restricted in some ways. And restrictions can be contractual, or they can be determined by the board of directors, all different kinds of things. So those are usually, any restrictions are disclosed in the notes to the financial statements. But given that we've got the retained earnings available, and in the case of a cash dividend, the cash available, we will figure out how to account for cash dividends. I should say that in accounting for dividends, most of the companies are doing cash dividends on their common stock. Some of them do on their preferred stocks. Not that many do stock dividends, and the in-kind or property dividends, not that much done at all. But yeah, we have to know about them. So anyway, so we've got 3 different dates, and some of this will be a review from AC 102 for you. But we get the declaration date, that's the date the board of directors declares the dividend. We've got the date of record, that's the stockholders who own the stock on that particular date will get the dividend. And then there is the payment date, which is fairly self-explanatory. Okay, so if we were, if a dividend were declared on August 1st, we would simply go, and to be specific, we would just go cash dividends, because this would be a cash dividends account that gets closed to the retained earnings account. But you could have cash dividends, property dividends, stock dividends, and all of them get closed to the retained earnings account. So on your homework, it's best to go, yeah, this is a cash dividend we're talking to. On the declaration date, that is when the cash dividend becomes a liability. Okay, so we have cash dividends, dividends payable. $1 per share on 2 million shares. I don't think I left quite enough room here. All right, so debit. Okay, so that would be 2 million. And 2 million. Okay. All right. The date of record would be 8/15. On that, we usually would not make a specific journal entry, but there would just be a memo that said, date of record. And then on the payment date, 9/9, this is where we reduce our dividends payable, reduce the liability, and we send out all of the checks for the 2 million. So your cash dividends, fairly straightforward, not terribly confusing. Okay, so property dividends. Let's take a quick look at property dividends. Property dividends are also called dividends in kind. And here the company is distributing some corporate assets that are not cash. The most usual one would be stock or some kind of investments. Okay, there's shares of stock in other companies. So and that's what we'll focus on here. And basically, the accounting for property dividends. Get rid of all this here. The dividends have to be accounted for at their current fair value. So there's a couple of step process here, and if you look at the notes, we've got this Coal Inc. that owns Marlin Corp stock, and so the stock is on the books at $8.75. Okay, so that's what it's on the books at. But the current market value, the fair value, if you look at the the stock market listings today, is 1.2 million. So here, that's a $325,000 increase in value. So the first step in doing a property dividend, and just say this happens on 9/1, is you would increase the value of those stock investments. Okay, there we go. And this would be an unrealized, because we haven't sold those investments. So it would be an unrealized holding gain, or it could be a loss. Okay, and that would be reported on the income statement. Okay, so it would be unrealized holding gain or loss income, and, it would just be the 375 would be the journal entry you would make to increase those investments from the 875 they were on the books to the current market value of 1.2. Okay, so then, once that's happened, now the board of directors can declare the property dividend. And so if they're declaring a property dividend, we will do something really tricky, like call it a property dividend. Property dividends. And the property dividends would be for the full 1.2 million market value, and we would have property dividends payable. Okay, of 1.2 million. Okay, and then you could have a date of record, as we did with the cash dividends. Now, look what happens on the 23rd when this is actually paid. We're going to reduce the liability, property dividends payable, which makes sense, but we're not, paying out cash here. We're paying out the stock investments. So we're actually distributing those stock investments to all our happy stockholders. So those come off the books also at the 1.2 million. Okay, so property dividends, not so bad. You just have to remember there's this extra step. They have to be adjusted either up or down from the book value to the current market value. You're going to have an unrealized holding gain or loss. When they declare a property dividend, and you've got a payable. You reduce the payable when you pay it and issue the stock investments, or you distribute them. Okay, so that's your property dividends, and the only other thing they talk about in terms of dividends are liquidating dividends. And liquidating means that they are kind of cannibalizing the company. They're taking the dividends not just out of retained earnings, but out of the actual paid-in capital of the company. So if we look at this, they're actually a return of the stockholders' investment. And so let's just see how this works. I give the example of this mining company that declared a dividend of $500,000, and of that amount, $125,000 is a return of capital. Okay, so this happens on 4/20, and so they've declared a cash dividend. So we don't call it a liquidating dividend, it's just a cash dividend. So we got cash dividends, and the total amount of the cash dividends, well, we'll hold off on that for a minute. We're going to have dividends payable. We have to do this so it makes more sense. We're going to have dividends payable of $500,000 altogether. Okay? Of that, $125,000 is a return of capital. So that means that $125,000 we're not going to call dividends. That's going to be coming out of paid-in capital. Okay, and in excess of par on our common stock. You remember, this will get closed to retained earnings. So the cash dividends gets closed to retained earnings. Retained earnings will be reduced only by the 375, because that's probably all that was in retained earnings. The balance of the 500 is a reduction in the paid-in capital of the company. So that's what you call a liquidating dividend. We're having to debit paid-in capital in excess of par on our common stock because there's no more retained earnings to cover it. Okay, so you get the three types of, well, you get your cash dividends, your property dividends, and your liquidating dividends. And the next video will look at your stock dividends.